Hey folks, Jed Bratt here, and in this video, I'll be giving you your January 2021 San Diego and Riverside County real estate market update. Now, we have a lot to talk about in this video. For starters, we're going to take a look at our recent numbers for San Diego and Riverside counties to see how we did overall in 2020. Next, we're going to jump into the latest information on interest rates, unemployment claims, mortgage applications, forbearance numbers, etc. We're also going to take a look at some data charts with other economic indicators and confidence surveys to get a better picture as to how the lockdowns continue to influence our economy. And be sure to watch this one through to the end, because towards the end, I'm going to talk about something very important that could be majorly detrimental to your wealth if you are not planning for it and aware that it's happening. And of course, if you aren't already a subscriber, go ahead and hit the subscribe button, hit the like button if you want to keep up on how to navigate the real estate market. All right, now let's go ahead and get started by taking a look at the most recent numbers for the San Diego and Riverside County real estate markets. So starting off, taking a look at active listings for both San Diego and Riverside. Riverside is the orange, San Diego is blue. All right, so San Diego County, we were down nearly 50% year over year in inventory, and the same thing goes for Riverside County. New listings were up slightly in both, 12.3% San Diego, 6.9% for Riverside. This isn't really indicating that much altogether. This is just simply saying year over year, this is the number of new listings that came in the market during this time of year. And basically what this is saying is that the traditional seasonal cycle of real estate is not following its normal course. It's not saying that we have a whole lot more inventory by any means. It's just saying that contrary to normally what happens in December, when we don't get any new, the market's pretty much on standby until the new year, we continue to see real estate activity. People are still buying and selling during that time. Pending sales year over year are up 25% in San Diego. Riverside was down a little bit because I think they had a little bit higher numbers this same time in 2019. Sold listings, despite the record low inventory levels, we are still seeing a 22.8% increase year over year in San Diego County sold properties and 30% for Riverside County. Dollar volume, this is really inconsequential. It's up 43% for San Diego County and 53% for Riverside County. That's the actual dollar volume that's happening. We know that because the median sales price has just continued to go through the roof. Riverside County, 16.9% year over year. San Diego County, 13.8%. Now, again, this is just for detached townhome, twin home, and condos. So your bread and butter real estate units. We have seen extraordinary appreciation across all of these, as you can see here. Market time in San Diego County was down 34.2% year over year and 41% in Riverside County. These properties are not taking their time in getting off the market. I know that 25 and 36 day number right over here might be a little bit misleading, but that's not really giving you the big picture. Most properties that are well presented and are in the sort of sweet spot, if you will, for single family houses, between $500,000 and $700,000 in San Diego, or the same in Riverside, those are usually going off the market, I would say, within 3 to 4 days often of being listed if they're presented well and priced well. Whereas this number also includes some of the higher priced inventory that kind of skews the numbers up a little bit. Don't let that mislead you. Next, let's go ahead and take a look at interest rates and see what we're looking at here. So we were on this constant downward trend, and we have pretty much not let up until right now. Just this last week, we did see a slight increase in the average 30-year fixed rate across the United States. A very small one. I think this was largely due to the finalizing of the election results. There was a great deal of uncertainty, and that kind of puts to rest any questions, I think, regarding who our next president is going to be. So I think that played a big part. The investors kind of said, okay, we feel a little bit better now. We can back off of these bonds, which is basically what's been happening is the 10-year Treasury note yield has been going up, so the prices are coming down. Demand's moving from that as investors are looking for other things to put their money into. Let's take a look at the employment situation. So as of January 8th, this is for the December employment report. The unemployment rate was unchanged at 6.7%, although we did decline by 140,000 non-farm payroll employments. rather than the non-farm payroll employment declined by 140,000. We've been seeing, this, of course, we had that major spike and then we have been recovering, but now we've been kind of plateauing here. And a lot of the experts are saying we're going to continue to see employment sort of plateau. We had that initial drastic loss because of the initial shutdowns. Then we saw a major springback for the jobs that were immediately needed once people got a grasp as to what the new sort of economy was going to look like after that initial shutdown period. And now we're just kind of putting along in the same level that we've been before. So nothing really crazy new here. Mortgage applications in the most recent weekly survey increased 16.7% from 1 week earlier. The report from the Mortgage Bankers Association says booming refinance activity in the first week of 2021 caused mortgage applications to surge to their highest level since March 2020, despite most mortgage rates in the survey rising last week. The expectation of additional fiscal stimulus from the incoming administration and the rollout of vaccines improving the outlook drove Treasury yields and rates higher. The 30-year fixed rates climbed 2 basis points to 2.88%, but reversing the trend, the 15-year rate ticked down slightly. They went on to note that sustained housing demand continued to support purchase growth, while activity was up nearly 10% from a year ago. Let's take a look at the forbearance numbers. Again, from the Mortgage Bankers Association, share of mortgage loans in forbearance decreased to 5.46%. The total number of loans now in forbearance decreased from 5.53% to 5.46% as of January 3rd. According to MBA's estimate, 2.7 million homeowners are still in their forbearance plans. The share of Fannie Mae and Freddie Mac loans in forbearance decreased to 3.919%. And Ginnie Mae loans, government-backed loans, Fannie Mae, VA and FHA, decreased 7 basis points to 7.85%. Forbearance share for portfolio loans and private label securities decreased to 10 basis points to 8.77%. The share of loans in forbearance slightly declined for each investor category entering the new year, remaining within the narrow range observed for the last 2 months. So we're pretty much just putting along the same way we have been. The data show that the homeowners who remain in forbearance are much more likely to be in distress, with fewer continuing to make any payments and fewer exiting forbearance each month. Those borrowers who do exit are also more likely to require a modification to their ongoing repayment plan. So the longer we go, the more months that go by through forbearance, the actual outcomes of the people coming out are going down, and then the ones that are actually coming out are needing more help than the ones earlier in the process. We could break this down by the type of loan, but it's really of no point right now. The bottom line is forbearances are continuing to pretty much maintain the same levels we've seen. They're moving slightly in a downward trajectory, but that's not a major indicator as to the any real progress that we're seeing. Household Pulse Survey. So I wanted to show you this. This is from the United States Census Bureau. This is just some charts showing what surveys are resulting for different people. So in California, we can see down here in California, we had a 42% response rate in the percentage of adults living in a household where it has been somewhat or very difficult to pay for usual household expenses during the coronavirus pandemic. And this is based on the most recent week 21. They've been starting this survey. They started this survey very shortly after the initial shutdowns, and they've been pretty much tracking this data each and every week. So still, in week 21 in California, 42% of adults are saying that it's difficult to pay for the what they would normally be paying for. Let's also look at this. This is the expected loss in employment income. This is, again, looking at California down here. 42.1% of Californians have expect someone in their household to have a loss in employment income in the next 4 weeks. So as you can see, even still in week 21, we are still continuing to see significant economic depression in many households, lots of uncertainty as far as the very short-term future for a lot of Californians. All right, let's go ahead and take a look at the National Multifamily Housing Council Rent Tracker Survey. This is looking at the rent payment tracker full month result going back to December. So in December, we were at 93.8% that had totally paid their rent by the end of the month. These different colors go by different times of the month. So on the 6th, by the 20th, and by the end of the month. So a very slight decrease continually since July, but really pretty much the same that we've been seeing for the last several months. Nothing really crazy here. No real change. San Diego Economic Survey, let's take a look at this just for a quick glance. This is as of January 7th, and the unemployment rate in San Diego County still stands at 6.6%. That's up from 2.9% 1 year prior. The United States, or California, is at 7.9%. U.S. is at 6.4%. So we're pretty much right in there. Really, this is, again, pretty much the story of everything else. It's not like we're too much different than California as a whole or the rest of the United States right now. We had a major drop in employment. We recovered slightly, and now we are once again starting to plateau. Now, I wanted to take a quick look at the most recent CoreLogic Housing Insights report, and this is a few pages into the report. If you want to check it out, just Google CoreLogic Housing Insights Report 2021. And this gives you some of the markets to watch as far as expected price appreciation, and also as well as some top markets to watch out for as far as risks of price decline. Some of the top markets at risk of price decline are Prescott, Arizona, has a 75+% chance of price decline. Lake Charles, Louisiana, Miami Beach, Florida, Brownsville, Texas, and Gulfport, Mississippi, all and on the top 5 lists for likely price corrections. Conversely, in San Diego County, home prices are forecasted to increase 8.3% in the next 12 months as low inventory continues to increase prices. So we're not seeing any cooling on the projection from CoreLogic's data and reports. Once again, it's the same story we've been talking about every single month here for the last year. As supply continues to dwindle and interest rates continue to remain low, and for the most of the year just continue to get lower, which we might be seeing a change in right now, we are going to continue, very likely, to continue to see this upward pressure on housing prices significantly. And 8.3%, I mean, that's pretty substantial. Now, I want to take a look at something real quick. This is the M2 money supply. This is from Fred economic data from the St. Louis Federal Reserve Bank. And this is going right back. This chart is we're only looking back at 1994 right now. But this gives you a pretty good idea of the trend of the dollar, the amount of currency in circulation in the United States. So we can see this is coming up here. We had a little blip during a recession. They pump in a little bit of currency in there to stimulate it. 2008. I mean, look at this. This is 2008 when we had the major Great Recession and we had a tiny little blip, okay? Relatively inconsequential. However, then we come over here, continuing the same trend line, and what happens? Folks, this is the money in circulation in the United States. We're going to talk more about this in a minute, but I want you to get a visual. And I also want you to understand this is prior to the next economic relief package, which is set to be passed, or at least it was just unveiled. Biden's one of $1.9 trillion. This hasn't even taken that into place yet. This is actual money that is being directly created and then pumped directly into the economy. Not in the same way necessarily as even direct quantitative easing, where the Fed is buying up assets such as mortgage-backed securities, which does provide liquidity to the mortgage markets. But this is directly indicative of money being injected directly into the pockets of Americans. Next, let's take a look at this. This is the dollar index. We're at 90.77% on the 1 year scale. This is basically saying that whereas a year ago, going off of $100 equals $100 scale, now $100 equals $90.77 on the same strength scale. Looking at the chart here, you can see that the dollar was doing okay, kind of holding itself steady, and then just right after the shutdowns, we've been continually dropping down now. And this is, again, not even including yet the new stimulus package, which should be coming out anytime here. Not stimulus, but the economic relief, rather. All right, so let's talk a little bit more about these last few charts. As we saw, the actual supply of dollars being pumped into the economy has increased by 20% in 2020. Folks, this means the total amount of money that has ever been circulated since the inception of the dollar has increased. There's an additional 20% amount of dollars out there than there was at any other time in the past. And keep in mind that as I'm making this video, this is still before the new multi-trillion-dollar economic relief bill that Biden just announced. Now look, I do understand that there are several factors that are actually deflationary in nature, which many argue will continue to keep inflation from posing a major risk for our economy. But I think there's something very important here and that you need to understand, and that's this. The more the government increases the total money supply and injects it directly into the economy, not only via quantitative easing, but also through stimulus checks, EIDL, and PPP loans, many of which are forgiven, the more dollars are out there chasing the same amount of products. And you can directly apply this to real estate. In the last decade, we've had double, triple, even quadruple the housing supply we've had available in 2020, but we've had fewer buyers. Now, with lower rates and more buyers than ever, home prices are constantly being driven up because there are more buyers and effectively more dollars chasing the same few available properties. It doesn't take a whole lot of imagination to understand that more dollars chasing the same number of products, what that does. Now, this doesn't have to affect everything. For example, there are many products and commodities of which there's a surplus of supply for. In these cases, prices can remain relatively stable or they can increase minimally. For example, as electric vehicles take more and more market share of the auto industry, gasoline might not experience as drastic of inflation as electricity. Or as another example, as demand for power has gone down as an aggregate in 2020 due to the lockdowns and less consumption, we've also seen the energy price index fall. Now, the traditional measure of the consumer price index might not be as accurate in the future as we've experienced it in the past. For example, although the cost of some items might go up minimally or even negatively due to the excess production capacity, like we just mentioned with energy, other costs such as housing are going absolutely berserk through the roof. Things like low interest rates had an inflationary impact on real estate prices because buyers essentially had access to more dollars for the same payment. Now, I think that there is a mental disconnect a lot of people are having right now and will continue to have as we begin to see more inflation because we aren't used to this sort of devaluing of our currency. People put their money into real estate and the price jumps 20% and they think that they're 20% richer, but that's not the case. Either that or they think the market's due for a major crash. But the fact of the matter is this: the country has set out on a path now that essentially requires we continue more of the same if we want to avoid the alternative, which is deflation and a shrinking economy. And you and I both know the government has demonstrated that they will do everything in their power to avoid that. But not only that, the Fed can actually use inflation as a strategic tool to erode away the debt that they are incurring as they continue to pump more money into the economy. See, as the government sells bonds to raise capital, they owe that money back in the payments of the term of the note. But what happens to the weight of the debt relative to the GDP as the government allows a higher inflation rate? The dollars the government will be paying that debt back with through the years actually becomes relatively smaller and smaller because they are paying the debt back with devalued currency. So who's the loser in this scenario? Well, the Treasury in this case is the borrower because they sell the bond and they receive the money and pay it back over time. And the bond holder, the investor, is the one stuck receiving a small fixed payback of that same money. So in other words, when a borrower borrows money at a low fixed payment during inflationary times, the borrower is the winner because they get the instant value of the funds before they become devalued. Whereas the lender becomes the loser as they are paid back over a long period of time, receiving dollars that become less and less and less valuable as inflation continues. So what does this mean for you and your wealth? Well, assuming inflation does pick up at a high level in the coming months and years, the value of your cash will be dropping. In a highly inflationary time, long-term fixed interest rate debt becomes an asset. So financed assets like real estate will continue to be one of the best hedges to preserve and grow your wealth as the value of currency decreases. And where are interest rates? Well, even if they go up a little bit, as we've seen in the last week, we're still at historic lows. And when you take out for example, $700,000 with a 30-year fixed rate fully amortized mortgage, you are essentially anchoring in that same low payment every single month. Except the dollars you will be paying it off with are continuing to get less and less valuable, while at the same time, the relative value of the property is becoming more and more valuable, both from inflation as well as appreciation. So using a grossly exaggerated example, say in 10 years, the median home price in San Diego is, let's say, $10 million, and your monthly grocery bill is around $5,000. Now that would be something crazy. That'd be crazy inflation. But think about it. You aren't going to be rich because your home is worth $10 million. Because if you were to go ahead and sell your home and buy another home, you're still going to have to shell out at least $10 million. No, you're well off because your monthly payments on that mortgage is only half of your monthly expenses for groceries. Yes, the house appreciated and hedged well against inflation, but the debt itself was much more of an asset than the property itself. So I want you to think about this concept because as our economy and monetary system shift with potential inflation, your mindset also needs to shift as well. Otherwise, you're going to be stuck thinking that you're getting rich because prices are going up, but you're not really paying attention to the fact that in reality, little bit by little bit, your dollar is being devalued. Personally, I'm going to continue focusing on acquiring real estate with long-term financing while rates remain low, because with inflation, the rules of the game change. Fixed rate, long-term debt becomes an asset. Cash becomes a liability as it goes down in value, and real estate continues to provide an excellent long-term wealth security, not only as a hedge against inflation, but as an income generator in addition to its tremendous tax benefits. And if you don't already know Ken McElroy, I highly recommend you check him out. Ken McElroy, he's here on YouTube. He has some great videos explaining this same topic and many more visually, and he puts out some really great content overall. I'll link to one of his videos here in the description below. Check it out. All right, folks, well, that does it for this video. Be sure to hit the like button and subscribe if you haven't already done that, as there will be many more videos like this one coming out in the coming weeks. And I'd love to hear your thoughts. Comment below on where you think San Diego, Riverside, LA County real estate is going in 2021 and why you think it's going there. And as always, folks, thank you for watching. I'll see you in the next video. Take care.